Good afternoon, everyone, and welcome to all of you. Thank you for joining us today for the second session of the Natural Capital Valuation Hub Valuation Dialogue Series. We're delighted to have you with us for this important and timely conversation. My name is Samir Trabilsi, professor of accounting and governance at the Goodman School of Business and director of the Natural Capital Valuation Hub. The Natural Capital Valuation Hub, NatCap Hub, is a Canadian-based initiative at the Goodman School of Business dedicated to advancing the understanding and application of natural capital valuation through research, industry partnership and collaboration and dialogue. The hub works to bridge the gap between the ecological systems and economic decision making, helping organizations, policymakers, and professionals better account for nature in financial and strategic choices. At its core, Natural Cap or NatCap is about asking a fundamental questions. How do we value what has long been invisible in our economic systems? Today's discussion speaks directly to that challenge. It is now my big pleasure to introduce our featured speaker today, Dr. Anup Srivastava. Dr. Srivastava is one of the world's leading scholars, writers, and speakers on the financial, valuation, strategy, governance, and executive compensation issues of modern corporation. He holds the prestigious Canada Research Chair in Accounting, Decision Making, and Capital Markets, and is a full professor at Haskins School of Business at the University of Calgary. Prior to this, he held faculty position at both the Kellogg School of Management at Northwestern University and at the Tuck School of Business at Dartmouth College. Anup is really a prolific scholar. He has authored numerous articles in top-tier academic journals, including the Accounting Review, Journal of Financial Economics, Journal of Accounting and Economics, Management Science, and Review of Accounting Studies. In addition, he has made more than 50 contributions to California Management Review and Harvard Business Review, establishing himself as a global leader in connecting and bridging the gap between academic research and real-world business practices. His influence also extends through editorial leadership. He is currently the editor-in-chief of one of the Financial Times top 50 journal, Contemporary Accounting Research, Canada's leading accounting journal, and serves as an editor for both Management Science and Accounting Horizon. Beyond academia, Anup plays a critical role in shaping professional practice. He advises CPA Canada and the Accounting Standard Board and contributes as an economist and mentor for the Creative Destruction Lab. He has presented to global standard setting bodies, including the FASB, which is the Financial Accounting Standard Board, the IASB, and the IVCS. His contribution has been widely recognized. He was named Influencer of the Year in the 2024 by AACSB and received the Distinguished Achievement Award from CPA Alberta in 2025. Before entering academia, Anup also held C-suite roles across banking, consulting, and industrial sectors, bridging a rare combination of academic rigor with practical insight. You are here for and to know about the talk today. Today, Anup will speak on investing in invisibles. And this topic sits at the intersection of accounting, finance, and sustainability, and challenges us to rethink how value is defined and measured in modern economy. And to guide our discussion, I would like to frame uh, a few questions for today's dialogue. The first one is, how is profit if nature is not being depleted? And how can accountants contribute to the preservation of natural capital? Uh, what challenges do accountants face when attempting to account for natural capital? Um, are there lessons or parallels that we can draw from the accounting treatment of intangibles? And what are the most important research questions going forward? Not just for accounting, but also for economics, finance, policymaker, and regulation. With that, it is my pleasure to welcome Dr. Anup Srivastava. Anup, the floor is yours.
Well, thank you, Samir. It's great to be here. Great to be on your platform. And thank you for your initiatives on national capital, ESG, sustainability. I always admire the initiatives you take. So it's great to be here. What I'm going to do is I'm going to share a presentation and let's see. And I'll try to answer your questions based on this presentation. So is the presentation visible to you?
Yes.
All right. So, my primary research is on intangibles, and natural capital interests all of us. Uh, and that's the topic today. So, I'm going to draw some parallels from intangibles to natural capital accounting and the challenges we face. So, um, I'll start with this number, $30 trillion. It's a big number, astonishing number. And this is 30 trillion US dollars. I'm going to come back to this number. Why is this important? Samir asked this question, what is profit? And I will pose this question to you folks and take 10 seconds to think about what is profit. Conceptually, what is profit? And I'll wait for 10 seconds. So, all of us have thought about this question. I've thought about this question. And the closest I could find to was I could go back to an economist, Hicks, 1930s. And he defined income or earnings or profits in the context of person, a human being. And he said that income is what a person can consume while leaving them equally well off. So if you had $100 to start with in your bank and you're left with $100, then the income is the amount that you should have consumed during the period. That's mathematical regularity. But the important thing is that your starting position and ending position is the same. And in fact, it's the same concept we use in accounting. So, though at least some of us who are accountants know the clean surplus equation, profit is the amount that a firm can pay out in dividends during a period while leaving the firm equally well off. And so the key point here is, again, I'm going to emphasize starting position is same as ending position. If firm's resources are held constant, then profit or earnings is the amount that the firm can pay out as dividends because its resource level is not affected. So keep this in mind when we talk about natural capital. Very basic principle, very important principle, but do we really follow it in our accounting? So how do we operationalize calculation of profits? Again, those who are accountants know it very well. Profit is revenues minus expenses. Revenue is the value of goods and services delivered, and expenses is the value of all factors consumed in during a period. So it could be raw material, energy, labor hours, cost of capital, so on and so forth. Okay, so we all know this. But now let's bring it to the context of natural capital. The fact is that when we do economic activities, we pollute the environment, we degrade water resources, we damage soils and oceans, we deplete forests and fisheries, we cause global warming. This is the consumption of resources. Do we consider them as expenses, as consumption of resources in our calculation of profits? So, when you talk about natural capital, I've just put a few elements out here: land, water, fisheries, wildlife, forests. When we consume those resources, do we take that expenses into account? And this is a violation of the principle we started with, that if we had certain level of wealth, natural wealth, certain level of resources, if we have consumed it, it is not held constant. And that reduction or increase, do we take that into account? So let's put that in the corporate context, something that we all understand. Firms depend on natural capital, they depend on ecosystems. We all know that every firm depends on ecosystem, and all firms, every firm impacts ecosystem. And again, my question is, are these dependencies or impacts taken into account? So let me give you a few examples. Let's look at a few industries: agriculture, food, beverage, land intensive consumer sectors. They depend on pollination. Food, mining, utilities, semiconductors, data centers, they depend on waters. Infrastructure, real estate, logistics, they depend on flood and coastal protection. Agriculture, forestry, they depend on healthy soils. And when we are consuming them, the question is, are natural systems quietly subsidizing the business model? And are we taking that subsidy into account in the calculation of profits? And so this was dependency. Let's talk about impact. And I'll want to quickly run through some of the industries. Agriculture and food production, there is a fertilizer and pesticide runoff, there is irrigation withdrawal, soil erosion, so on and so forth. Mining, oil and gas, and extractive industry, so land disturbance, tailings and acid drainage, groundwater depletion. Electricity, utilities, and power generation, there is thermal water, thermal and air uh, pollution. Manufacturing and chemicals, there's effluent discharge. Construction, real estate, there's effect on land. Forestry, pulp, paper packaging, there's deforestation, forest degradation, biodiversity pressure, soil disturbance. Transportation and logistics, there are emissions, there is runoff, noise, apparel, consumer goods, retail, upstream land conversion, cotton water use, chemical dye pollution. And this is the emerging thing. One of the biggest capital expenditure, at least in US. So technology, data centers, and electronics. There's electricity demand, there's cooling water, there's noise pollution, there is e-waste, so on and so forth. So the question is, what can accountants do? And did accountants do their job? And that's the question I pose. Uh, One solution is put nature on the balance sheet. And then the question is, did we do it? And the answer is clearly no. Uh, if we did it, then what we would have done is we would have adjusted every income calculation, whether it is at corporate level or at national level, for creation or destruction. That's creation or consumption of resources. So, for example, if we were calculating GDP, then we would have said this is our starting position. If we added to natural resources, so we cleaned the water, we improved the ecosystems, we planted more forests, then we created something that should be added to our nominal GDP. On the flip side, if we depleted our natural resources, that should have been subtracted. But the fact is that we look at GDP purely as dollar inflow and outflow, and we do not consider the fact that the resource level is not held constant, it is added or depleted. And why is it important? Why is calculation of income important or earnings is important? Because if we do not calculate income properly, we cannot have any contracting. So our contracts will be inefficient. We cannot incentivize people for enhancing natural capital. So if there are societies or there are systems, indigenous people who are creating natural capital, we cannot incentivize them. We cannot penalize people for degrading natural capital. And therefore, uh, all that talk that we do about enhancing natural capital is all in the air, and it does not translate into policy actions. And again, I'm going to say that accountants have failed in this job. I'm going to talk about accounting of intangibles, which should have been the starting point. We failed in that. We failed in ESG. I'm going to explain that. And natural capital accounting is actually towards the end in the continuum of complexity. If we could not solve the first order problem, how can we solve a more complex problem? And even when we talk about natural capital, we are talking about ESG, and then there's climate, then there's biodiversity, and there's natural capital. Again, there's a continuum of complexity. And without solving the first order problem, we cannot hope to solve the more complex problem. So let's start with where did we fail in accounting for simple things, which is corporate financials. So we know that the biggest value creator in economy today are intangibles. And I'm going to give some names. And the fact is that their most important resources, brands, intellectual property, patents, customer relationships, etc., are not considered assets. So they're not on balance sheet. So if they're not considered assets, neither the creation nor the depletion is considered in financial measures. And if we had put them on the balance sheet, then their changes would have come flowed through income statement, which is going back to Hicks definition. Take the increase and decrease into account. And so we do not consider them assets. If we do not consider them assets, neither increase nor decrease is taken into account in income statement. So where does this $30 trillion number come from? Well, that's the value of intangibles in the economy. So here are the most valuable corporations today. You all know those names. You even know those numbers. Nvidia 4.5 trillion, Apple 4 trillion, Google 3 trillion, so on and so forth. And I'm going to talk about their assets, which are not considered assets. And what we really consider assets are assets of General Motors or US Steel or Exxon, etc. And the interesting thing is that you can add all of these giants together and they will not add up to even one company on the left hand side. This is how important intangibles have become. So let me give you an example. Uh, think about Facebook, think about Google, not Alphabet, but Google as a business, or Apple. Their most important asset is business idea, innovation, customer and social relationships, computerized data, and software. They're not considered assets. What we consider assets are factories, land, building, warehouses, inventory, so on and so forth. And we consider them assets. We take care of their increase and decrease in our balance sheet and income statement. We forget the most important assets. So if you don't believe me, so I'm going to give you some examples. Let's start with the concept of financial statements. Concept number one, the very basic concept statement, which said that financial reporting should provide information about the economic resources of an enterprise and the changes in those resources. So economic resources, the position, that should be in the balance sheet. If there are changes, they should flow through income statement. Do we do it? We don't. So which are the most important assets for Apple? It's the most valuable brand on the planet. It's technical know-how. That's what makes Apple so successful. And its network and platform of subscribers. We all agree that these are the most important resources of Apple. Where are they on the balance sheet? This is a real balance sheet. It's an old balance sheet, but you can look at modern balance sheet. None of those assets are presented on the balance sheet. If Apple buys a truck, it goes on the balance sheet. It develops the most valuable brand, the most valuable technology. It does not go as assets on the balance sheet. And this is a result. In fact, the book value of Apple on a certain date, just a couple of years back, was $60 billion. Its market cap was about $3 trillion. 50 times. I'm not talking 50% here. I'm talking 50 times. 49 out of 50 was not in the balance sheet. So these $30 trillion, which is almost one half of today's US market cap, is not considered an asset. So we do not consider it as an asset. We do not take increase or decrease into account. Here is an example. If Nvidia or Apple creates brands or patents, its financial position improves. It is not held constant. It has gone up. But it is not considered a value creation in income statement. On the flip side, Nokia or BlackBerry, they destroy value. Position is not held constant. It has gone down. it is not considered value destruction because it was not even there on the balance sheet. If it gets destroyed, how can we consider it as a loss? And therefore, that principle of income statement is lost. Again, if you don't believe me, I'm going to explain this. So, in fact, the starting and ending position are not equal, and therefore, income statement is all wrong. So, if you don't believe me, consider this simple example. Revenue cannot accommodate some of the value creating events. Google discovers a new search algorithm, it creates a $3 trillion company. It cannot go in the revenue. Expenses, we take all the expenses into account. Some are matched to revenues, all the physical ones, but all the intangible investments are considered expenses. They're not capitalized, and this distorts the income statement. So, in fact, all these good things are not considered investments, which is our accounting problem, which is where I wanted to start with. That if you do not consider investments as assets and consider them as expenses, we actually put them in SG&A. In fact, my research shows that SG&A as a percentage of firm's total cost has been increasing. Physical costs have been declining. So the most value creating uh, investment that we make, we do not even consider it as investment. In fact, if you don't believe me, I hope you recognize the names of these companies. You can eyeball them. You know them all. For all of them, the investments, that's intangible investments, exceeds their physical cost. But we do not consider them as income. And that leads to distortion in matching. I will not go through this, but all I will say is that in old times when we relied on physical infrastructure, we had perfect 1:1 matching. In today, our matching is down to 20 or 30%. And those who are accountants will understand that if expenses are not matched to revenues, the income number is meaningless. So any number that you use from balance sheet or income statement for modern technology companies, asset number is wrong, income number is wrong. So if you're calculating market to book ratio, asset coverage, debt to equity, anything you calculate is fundamentally wrong. Those who use DuPont, I challenge you if you can do it for Facebook or Microsoft or Alphabet in economic terms, not accounting terms. So this was a simple problem and we failed. So we failed for accounting for intangibles. Then we thought we'll create a single metric for ESG. We made tall claims, we failed, and now we are saying that we will solve natural capital problem. And again, I'm repeating the same thing. Unless you do proper accounting, you cannot calculate, you cannot add value to the society. Um, so uh, we need to adjust for creation or destruction of natural capital. We need to add, we need to subtract. Where do we start? Well, we need to consider both stock of natural capital and changes thereof in our calculation. We need to put the stock value in the balance sheet. We need to put the changes in our GDP calculation, whether it is cities income, whether it is provinces income, whether it's corporate income, whether it is municipalities income. We need to take both stock and changes into account. And we also need to consider transfer pricing. So, resource consumption, for example, just think about four options that produce hydrocarbons. One is offshore oil rig, one is onshore oil rig. Think about fracking and think of oil sands. Four ways of producing hydrocarbons. And then put coal mining also into the picture. And they affect natural capital in different ways. Some affect water resources, some affects land, some leads to drinking water pollution, some leads to fisheries depletion, so on and so forth. And how do we calculate transfer pricing? How do we say that this is more important than that element? This is where accountants need to come. This is where they specialize in. They can help you calculate value of stock, they can help you calculate the value of changes, and they can help you calculate the value of trade-offs that you have to make within resources. Where to begin? Let's start with intangibles. Let's learn. We know. Uh, I'll give you some examples: intellectual property, brands and trademarks, customer relationships and data, human capital and software. Data as an intangible asset. We accountants have developed some methods. We don't use them, but we have developed methods. We have cost method. What will it cost to produce another Coca-Cola? Market method, what price is an IP sold for? Income method, if we had that IP, what is our incremental income? really from royalty. If we rented that brand, or if we rented that uh, trademark, how much would we have to pay? What is its present value? Excess earnings method. If we had an R&D, will it lead to increase in revenues or decrease in costs? What is the excess profit because of that intellectual property, present value? And we can calculate valuation. Let's apply the same to natural capital, market price, timber, avoided cost. If we do not take care of floods, or we do not take care uh, of drought conditions, what is the impact? But if it happens, what is the cost? What is the replacement cost? If there's a landslide, if you have to fix it, what is its cost? What is the production function? If you are using water for production function, what is its value? Stated preference. Do we want clean air or we don't want clean air? Do we want forests or we don't want green cover? Stated preference methods. So we can create valuation methods. This is accountants can do. That's our core competency. Accountants, our middle name is count. Let's figure it out how to calculate the value of these resources. So I'll not take time in doing going through this, but I'll quickly run through water resources. We have some methods and we can try them. Provisioning value, regulating services, scarcity pricing, replacement costs, forests, some methods, ecosystems, we have some methods, air quality, we can create some methods, culture, let's not forget it, we can create some method, fisheries, we have some method, land resources, again we can create some methods. And I'm trying to put it it may sound simplistic, it is not simple. Again, I'm going to say that we have to start with intangibles, and this is a higher order problem. This is a higher order problem because there are multiple dimensions. Go back to my hydrocarbon problem. How do you trade off land versus water? um, it is also specific to a location. Water, for example, in Middle East has a different value of water in Indonesia, but oil in Middle East has a different value than oil in Indonesia. So it is very specific to space. Thresholds, these are not linear. It's not that more is better or less is less. There are non-linearities, in fact, and there are thresholds beyond which it becomes irreversible. Think about fisheries. If it crosses a certain threshold, it leads to depletion. So these are not simple, but let's not throw the baby out of bathwater. For accountants, we can have your measurement issues, disclosure issues, assurance issues, valuation issues, governance issues, pricing issues. We can we can add value in that. And unless we do that, we cannot talk about the stakeholder capitalism. Here's a Harvard Business Review article that I wrote with Professor Vijay Govindarajan on we cannot have stakeholder capitalism unless we have performance measures. So, and it's a multidisciplinary thing. We need to take ecology, accounting, finance, management, public frameworks. Multidisciplinary approach is required for preserving natural capital. I'm going to leave with a couple of thoughts. These are powerful statements that I really like. Keynes said it's better to be roughly right than exactly wrong. Let's at least try. In intangibles, we are exactly wrong. We said Apple's brand value, zero. It's, we were exactly wrong because we didn't want to try. Peter Drucker said, what gets measured gets managed. This is what you use to incentivize, this is what you use to penalize, this is what you need to tax, this is what you need to provide subsidy. And Einstein said, not everything that can be counted that counts can be counted. So I will leave with this statement that I hope that accounting community picks up the challenge for taking some of the most important issues confronting the society, and we need to start with intangibles and apply that framework to NCA. So this is my thought from intangibles to natural capital accounting. So thank you for listening.
Thank you very much, Anup, for this great uh, insight that you shared with us today. We have like uh, 15 minutes to take on question both from YouTube and LinkedIn. Uh, so, if there any question, is there any question?
Samir, can you see them? I cannot see any questions.
Yeah, they're going to get posted on the screen.
Okay.
Um, let me while waiting for the audience to post their question, you said like accountant failed in terms of intangible, in terms of ESG, in terms of natural capital. Are you Do you mean that we're going after like mega problem rather than going like very simple and start small? And why we failed? What's the driver? And how can we go forward? What can we learn from the experience of intangible and ESG that we can get it right in terms of natural assets valuation?
It's an excellent question. I think so. My research is on intangibles, and the world changed slowly. It's not that overnight we had Nvidia as the most valuable corporation or Apple had as the most important corporation. Things started happening in 60s and 70s, and we thought these are small issues, and somehow these problems will go away. And dot com burst in late 90s actually sort of provided us comfort that these are fine, these are overnight operators, they'll be gone, and what really matters are physical companies. And therefore, we didn't do anything. And suddenly, we have this elephant in the room, uh, and we didn't realize when it became an elephant. It's the same problem with ESG. Yes, we all started with good intentions. Uh, we um, we had some values. Our values prompt us to do some good things about the society, but we did not tackle the issue of measurement, which is valuation. And measurement specifically for different dimensions, as well as determining transfer pricing. For example, if you have to do something but compromise on some other elements, how do you take that into account? These are not easy issues. Single metric is impossible. If there are accounting researchers out here, they end up using KLD as a standard metric. And frankly, to me, uh, putting the journal editor hat on, it doesn't mean anything. Okay, you can't compare grape to a watermelon, to a camel, to an elephant, to a whale. These are different issues, but we thought that it was easy problem because we did not learn the basics. So going back to your question, where did we fail? We did not take simple steps. Let's go back. We accountants thought that our job is to basically apply the principles that have been created by FASBs of the world, rather than say that we understand economics, we understand the value creation potential, we understand the value destruction potential. We have different methods, opportunity costs, uh, you know, uh, residual income valuation method, etc., etc. We can use some of those methods to at least try to estimate. We thought, let's hide behind the curtain and let's shy away from difficult issues. So unless we start taking courage, and anybody who took courage was accused of doing creative accounting. So we threw the baby out of bathwater. And now we are confronting issues like intellectual capital, big issue, natural capital, big issue. But we did not start small, and we can still start small. And actually, this is the best way to attract the talent back to accounting. Instead of just implementing accounting regulations, we can attract talent who knows finance, who knows economics, who knows engineering, who understand ecology, can now put the accounting hat on and improve our measurement and lead to some of the stakeholder capitalism that we often talk about.
I have a follow-up question, but I will give the audience to ask their question. Financial market have a long history of mispricing or only partially recognizing intangible. Why should we be confident they will do any better with natural capital, which is even harder to measure?
It's an excellent question, and it leads to type 1 and type 2 problem. Okay, type 1 error or type 2 error. In our eagerness to get perfection, we didn't do it. We didn't put Apple's brand on the balance sheet because we thought that it will not be perfect. And we put truck on the balance sheet because we know that truck we spent $1 million or $10,000 in buying a truck. So, yes, and this is where I said it's better to be roughly right than to be precisely wrong. The fact of the matter is that you cannot be perfect because perfection does not exist. In fact, I often start my presentation by showing pictures of two roses, and I say, beauty lies in the eyes of beholder. I'll pose a question: how do you value Pythagoras theorem? Everybody understands Pythagoras theorem, right? How do you value it? Is it $1? Is it $1 trillion? Is it $100 trillion? From an architect's perspective, it's a different value. For a landowner, it's a different value. For a scientist, it's a different value. But to say that we will, because we cannot estimate its value, we're not going to do it. Unfortunately, that has been our attitude, and this was our attitude with intangibles all along, which has led to the elephant in the room. So this is an era of experimentation, and let's reward experimentation rather than whack-a-mole. If somebody tries to do it, we whack them on the head and say you cannot. In fact, let me pose the question back to you: does anybody on this planet know how to calculate the value of any physical asset? We think we know it, right? But what do we put on the balance sheet? Historical cost. Is historical cost really the value? It's not. Land, the most important asset that we put on the balance sheet. Is land same as its market value? Is that the same as its replacement cost? Is that the same as its income potential? It is not. So we think that there are certain things that are easy to measure, other things that we avoid because we don't want to take risk.
I think Don has a follow-up question. He said, "Do you think uh, natural capital should always be translated into monetary value, or there is cases where non-monetary indicator are actually more decision useful?"
Absolutely. Absolutely. Uh, going back to my rose example, I show two pictures of roses. Is this more beautiful or that more beautiful? But at the end of the day, the fact is that if we want to do transfer pricing, for example, can one say if there was a project which involved moving of people to put a dam or to create a watershed, so that will lead to destruction of a culture but will lead to better water management. How do you do it? Each one is right, each party is wrong. I mean, each party is wrong and each party is right. How do you do it? And there we need to take some strong decisions, and unless you put some monetary value to it. So I agree, it is impossible and it is difficult, and there are times when we have to take how do you put value to human life? How do you put value to culture? Not easy, but we have to start somewhere. Without taking that into account, you cannot calculate the net impact of a decision. And if you cannot calculate the value of net impact of a decision, you cannot calculate the value of that decision to the society, whether it's positive or it's negative.
Another question by Nilay: "What are your views on measuring the disclosure made by management for the natural capital? The integrated thinking, combining various capitals, is there, but its impact is questionable."
Yeah, so I think the answer is already there. uh, the second point that it's questionable, but it's better to have disclosures than not have disclosures. In fact, research shows that the soft talk, the discussions are often more valuable than some of the hard numbers, because hard numbers miss many issues. To draw my analogy from intangible world, whether a firm is developing new markets or they have plans for new products or what market segments they are targeting, perhaps often they are more relevant than revenues or expense numbers that firms put on the balance sheet or income statement. So, are they perfect? No. Are they value relevant? Perhaps more than the hard numbers, recognized numbers.
My yeah. So there is this additional question about, is conservatism then a cardinal sin in the current accountancy regime?
Well, it's a value laden question. Uh, I don't even know what conservatism means. First of all, conservatism in 1 year means aggression in another period. So if you recognize the expense today and you do not recognize it tomorrow when it should have been recognized, you produce lower profits, you report lower profits today, but you report higher profits tomorrow. Number one. Number two, we apply it inconsistently. Why is it that if I spend on atoms and molecules, it is considered a value creating asset, but investing on R&D is not considered creation of an asset? Do physical assets create value? Tell me this answer when we talk about data centers or windmills, or along comes one stroke of a pen of one official, and all the windmills or all the solar projects become unviable. Why did we put them on the balance sheet to start with? Acquisitions, when we acquire R&D, then we put it on the balance sheet. We develop R&D, we don't put on the balance sheet. So it's not a question of conservatism. Where is the consistency, right? So these are all value laden questions. No perfect answers to these questions, but let's not throw the baby out of bathwater, which is what I'm going to repeat over and over again.
I had a follow-up question to the is what would need to be changed in terms of standards, in terms of incentives, or even in terms of mindset for natural capital to be treated as seriously as financial capital?
So it's a good old problem. We human beings act on our incentives. Uh, why do managers produce profits? Because they get rewarded based on profits. Profits leads to bonus. Profits lead to higher stock prices. So it leads to higher uh, stock compensation. Unless we bring those measurements and um, both rewards and penalties. I want to talk about rewards as well. There are indigenous communities that are creating natural capital. Are we rewarding them? And the people who are consuming those natural resources, are we penalizing them? Unless we have, go back to Peter Drucker, be managed. Unless we do both, we cannot manage it properly.
Now, uh, there is this amazing, yeah. This question is, yeah. If you had to identify one lesson from the history of intangible asset valuation that policymaker and standard setter absolutely should not repeat in the natural capital space, what would it be?
It's the statement that I've said over and over again. It's better to be roughly right than to be precisely wrong. Standard setters were precisely wrong when they said that we are going to consider atoms and molecules as value creating and knowledge as not as asset. If we do not consider, if we in our quest for perfection, that we need to get it absolutely watertight. Unless we have watertight systems, we're not going to create any accounting or measurement system. If we do it, then we fail, because there exists no method for calculating value of fishery or culture or watersheds, and there exists no method by which based on transfer pricing can be determined. But if we do not take steps, however error prone they are, then we are not going to improve on those systems.
Yeah. So there is this question, uh, what are the risks to investor and firms if natural capital continues to be excluded from financial reporting?
So I will say that the uh, investors is too narrow a term. Actually, there are not too many risks unless we start penalizing firms. So yes, of course there are risks, and we know those frameworks. There are physical risks and there are transition risks. Uh, but I think this is a bigger issue. It is not just about equity investors. Equity investors are sort of uh, excluded from some of the penalties, that some of the costs that they're imposing on natural system, uh, nat- you know, natural capital. Um, I will say that our current systems are They are designed from shareholder perspective. They're not designed from stakeholder perspective. Uh, the point I'm making is we need to think bigger, and we need to consider any economic activity that happens anywhere on this planet as for wider society and not just for equity shareholders.
Yeah,
In fact,
I
to
agree.
give a live example, the biggest investment in last 3 or 4 years, at least in the United States, was on data centers, right?
Yeah,
And what is data center? It's power hungry, it's water hungry, uh, it consumes natural capital. Uh, does Microsoft's balance sheet or does Google's balance sheet uh, take some of those externalities into account when it reports to its shareholders? Shareholders are shareholders will they're capitalist. They will benefit in any state. Let's talk about other stakeholders in the society.
yeah. Now, most of these assets are owned by the government, right? So, and the question becomes, what role should the regulator and government play in accelerating the integration of natural capital into decision making?
So,
Do they have a role to play?
I mean, what is government at the end of the day? Government is you and me, right? Government represents us, and that's the wider stakeholder. The government should create that framework based on which those penalties and rewards can be um, awarded to the economic players. So, if there's a steel mill or there is a power plant and it consumes clean air, it consumes clean water, uh, has that cost externality that it imposed, whether it has been internalized or not, whether it is taken into profit calculation or not. It's government's job, where government is representing the other people who do not directly benefit from that event, to say that you need to compensate us for this. So yes, natural capital is owned by government, but government is owned by people. Uh, hopefully, at least in democratic societies, um, and it's a transfer pricing, it's subsidy, it's penalties, and those need to be taken into account. Taxes, they should be adequately capped. They should be adequately imposed while taking the creation or depletion of natural capital. That's government's job, and of course, if government doesn't do it, then who will do it?
Yeah. There is this question: how would the current litigious legal regime need to change in order for those measures, valuer or assurer of such monetized values, who may only get roughly right not to be penalized? So the problem is that
Yep.
you are advocating for, let's start somewhere, and we know that it's relevant but it's not reliable. And the question is, we are in a litigious environment like the US environment or many other environment. What will happen? How can we reconcile this lack of reliability with relevance, right?
So Shiva Rajgopal and I wrote an article in JACF, and I have a thought piece in Accounting Horizons where we talk about alternative reporting systems, and let the one that is prescribed by FASB or ISB continue, and let's have another alternative reporting system. It's almost like MDNA. It MDNA, a manager is allowed to speak, and they are given certain protection against litigation. Biotech firms often reveal their most important information not through financial statements but through their disclosures. Oil and gas companies have an alternative way of what is the value of the resources underground, which have been discovered, which are proven, which are unproven. That's not a part of financial statements. So there are alternative. We accountants should not silo ourselves only to what is regulated financial reporting. There are alternative ways which are useful not just for shareholders but also for wider variety of stakeholders, and we need to improve them. I have no hope, having presented it to standard setters, I have zero hope that at least in my lifetime intangibles are coming on the balance sheet. So let's continue with the old system. Let's do it because It's a ritual we need to perform, which doesn't mean anything, but let's shift the value creating information systems to somewhere else. Uh, and so that it is not affected by regulation, it is not affected by litigation, but it affects some real decisions in the society.
Um, I'm going to put, yeah, this is an amazing question. Where do you see the greatest opportunity for collaboration between academia, industry, and platform like our NatCap Valuation Hub to move this field forward?
We are academics, right? We think economics, we think we some of us are engineers, some of them come from ecology side, some of come from finance side, some of us come from accounting side. Let's think about, if we consider this as an important issue, let's do research on that. Let's come out with valuation models. Let's talk about merits and demerits of some of those methods. Let's talk about in which situation this method works, in which situation the other method works. Let's not let's not in the quest for perfection, uh, let's not attempt. Let's attempt, and it requires multiple inputs. For example, if you're talking about valuing an ecosystem, unless you have engineering inputs, unless you have geology inputs, unless you have chemistry inputs, unless you have finance inputs, unless you have accounting inputs, you cannot do it. It requires collaboration. It's not a single discipline, it's not cannot be done by one person, but it requires all those competencies to be brought together. uh, Cross disciplinary research, but again, in all of this, I will say that some risk taking in on part of us, rather than continue on our linear path of, I'll give you a simple example. All of us use total assets as a scalar, those who do accounting research. We know total assets is a meaningless term. What is total assets for Apple? And why do we use it as a scalar? What is total assets for NVIDIA? The most consequential companies in the economy, we still use total assets as a scalar. So why can't we think about improved ways? And that requires risk taking, and it requires multiple inputs, uh, which can add value to the society.
Yeah. There is this last question. Given the complexity and uncertainty in scientifically derived environmental data, what challenges do you see in integrating such a data into natural capital accounting without compromising credibility? Yeah, the story of credibility, reliability,
It is
and
coming again and again, which I will say that which was our strength of accountants, but has also become weakness. Because unless we do something in a watertight fashion, we're not willing to step out of our our comfort zone. Let's all agree that first part of this sentence is important, and we want second part as our precondition. But if we impose that as our boundary condition, we'll never take the first step, because the first step cannot be taken with perfection unless we experiment, unless we try models in our quest for perfection. Same thing, Apple, since we cannot calculate its brand value, we're not going to put it on the balance sheet. It's the same problem. But let's
absolutely,
try. It's better to have some value. It's better to be roughly right than to be precisely wrong. Let's all agree that value of Apple brand is not zero. It is the most valuable brand on this planet. But since we
absolutely,
cannot calculate its value, therefore we're not going to use it in our decision making. We're not going to reward people who create that brand, enhance the brand. We're not going to penalize people who destroyed the brand or deplete the brand because we could not calculate its value. So we're going to throw the baby out of bathwater. Let's move to a world where let's be roughly wrong or roughly right than to be precisely wrong.
yeah. The final question is, uh, I know there is, I really want to thank all the participants that joined us today live for this Natural Capital Valuation Hub Dialogue series. If listeners or those who watch this recording later, and I can tell you there's a lot, like we have the first with Jonathan, and it was really there was a record number of viewers on that session. Uh, Take away just one key idea from today's discussion. What should it be?
Two interrelated ideas. One is let's think more widely. So we think from multiple disciplinary perspective rather than sitting in our own silo. So let's bring engineering, let's bring science, let's bring ecology, and let's work together. Number one. And number two, let's experiment. There were two scientists who created a Google search engine formula, which created a company which is now thinking about a driverless car, Waymo, right?
Yeah.
We do not know what the possibilities are unless we step out. And we need to step out of our comfort zone to create perfection. So let's think more widely and let's experiment.
Thank you so much, Anup, for such an engaging and thought-provoking discussion. Your insight into the parallel between valuing intangible and natural capital have given us a great deal to reflect on as we are really developing our detailed description of this SHIRK partnership grant proposal, and especially the role of accounting in making the invisible visible and in shaping how we define value and performance in today's economy. In fact, the conversation really underscores the importance of a continued dialogue across discipline as we work together with our industry partner, government, toward a more kind of comprehensive approach
Mhm.
to valuing natural capital. For our participant, we are very pleased to continue this conversation in our next session of the Natural Capital Valuation Dialogue Series that will take place on April 7, where we will be hosting another thought leader, Miss Neila Benzina. She's the founder of the and CEO of 1B Tech, and she has been honored as the Chevalier de la Légion d'honneur of France, one of the country's highest distinction. I really hope, and we hope, you will join us as we continue exploring new perspective on natural capital valuation and decision making. Thank you all for being with us today, and we look forward to seeing you all on April 7th. You have an amazing afternoon, and goodbye.
Thank you, Samir. Bye.
Thank you, Anup.